Welcome to the ICCU Solutions for Life podcast, where we empower you with the financial tools and knowledge to take control of your future. I'm your host, Nicole Mazurkovich. I'm the marketing director here at ICCU. Today, we're diving into the world of credit scores, what they are, why they matter, and how you can master yours and unlock your financial freedom. Joining me today is Andrea Barber, our financial services manager, who brings a wealth of experience helping members navigate their credit journeys. Andrea has been with ICCU for 25 years now. You've hit your milestone this year. Mm-hmm. And can you share a little bit about your background and your time here at ICCU?
Absolutely. I have been at the credit union, like you said, for 25 years. When I started here at the credit union, I started as a part-time employee of frontline staff. And through my journey here, I've spent approximately 23 years of those in lending.
Nice. Very nice. Well, we are lucky to have you. You are very good at your job, and I know that members absolutely love talking with you. So as we dive into credit score, let's just start with a basic explanation. What is a credit score, and why does it play such a big role in our financial lives?
Well, let's just start with what a credit score really truly is. Credit score is pretty much a 3-digit numeric number that is pretty much on a graded scale of 300 to be the lowest, up to 850 to potentially maybe a 900 these days. The score is calculated based upon the likelihood of you having repayments on your debts or trade lines on your credit report, or your likelihood of repaying your bills on a timely manner.
Okay. And so why is it so important that people pay attention to that credit score?
Well, your credit score follows you through your journey of adulthood. It's always going to be there. It can be high, it can be low, it could, fluctuate. And it's something that will carry your credibility as a number to portray who you are through your journey of adulthood.
Okay. And do you have a real life example of how a credit score can negatively or positively impact an individual? Say I'm graduating from high school or college and my credit score is not very good, or it is very good.
There's a lot of misconceptions on good, bad, indifferent with credit scores. So when you're starting out, as an example, some individuals won't have a score at all. So it'll be blank, zeros, nothing. And when you're walking through that journey, when you're beginning to obtain your credit score, it follows you, but you need to start it out on the right path. Some people want to take out too much credit at one point in time, which could damage yours, or some people are scared of it, which will hold you back and give you a 0 score. It's not anything positive or anything negative. You don't have anything.
Right. So now that we understand what a credit score is, let's dive into the details of how it's calculated. This part kind of feels mysterious to a lot of people. So could you walk us through the main factors in determining a credit score?
Yes. So your credit score is determined by 5 major areas of how it's calculated. The most important part of your credit score, how it's calculated, is your payment history. So your payment history is whether you pay your payments monthly, on time, when they're due, every month. It could be a credit card payment, an auto loan payment, your mortgage, anything that would report to the credit bureau as what we call a trade line that pertains a payment history. And it's like 35% of your score is made up by your payment history. The other big calculation that comes into play with your credit score is credit utilization, or what we call capacity. So what that is like, for instance, if you have a credit card with a limit of $5,000, you don't want to always keep it at your max. So you want to allow some leeway there. So if your limit on your credit card is $5,000, we always would recommend our members to don't take that more than 50%. Leave yourself some utilization, or what we call capacity. A couple other of them are a little bit smaller, is the length of credit history, or the time you've had your trade lines. That's a small amount that's calculated. The new trade lines, so if you have a new auto loan and a new mortgage and a new credit card, those inquiries and those new trade lines also take place in a small portion. Probably 10% of your score is calculated by those attributes. And then the last one is most likely your credit mix. And when we talk about credit mix, we're talking about whether it's credit cards, auto loans, mortgages, just a good mix. You don't want to have everything on your credit report unsecured, and you don't want to have everything on your credit report secured either. So you want to keep a good mix of what you have. And I always make a big suggestion to limit department store credit cards. Those not necessarily are a good thing to help your score or keep it at a higher. Sometimes those are a little bit of a hindrance.
Okay. So why is that payment history considered the most important factor? What is that? Why is that attribute so?
The payment history is calculated the most important part of your credit score, because when people are looking at wanting to lend you money, we want to make sure that you have that score to carry, that we know that score is going to pertain to the ability for you to repay your payment with us.
That longevity that I'm making sure my car payments are on time and stuff.
Yep.
For someone that's new to credit, what would you say about the importance of building a credit history over time?
It's one of the biggest things or misconceptions I think that people have when they're new borrowers. So a lot of times people will say, they want to get a mortgage and they don't have enough established credit. So one of the misconceptions that they have is, well, they're told they have to go out and get credit. So we'll see people come in that go out and get like 5 or 6 credit cards, or they just apply. So they have 25 inquiries on their credit report, which unfortunately hinders that. Yep. It hurts them. So when you're trying to be that new borrower, you have to just take that step back and just take out, whether it be a small credit card. My personal preference on someone that's starting out is to start them out on a closed-end loan, which that is an unsecured loan that has a term, for 12 months, 18 months. So it shows that they have that availability to repay, and there's not a revolving line, and that will help them.
Nice. So what advice do you have about someone that is opening a new credit card? Is it okay to go to a couple different places, or should you stick with one? And does that help keep that healthy mix if you only have one?
If I was starting out with trying to make sure I have a good healthy mix, I know a lot of people will try to go to the department stores or Amazon or these other things. I would encourage them to either go to your local, financial institution, or go to like a big credit card company where they can take on a little bit more risk and get them started with being able to obtain their first credit card. But my suggestion is, if they take out your very first credit card, you should have it with someone that you trust, because the longer that you have that first credit card, the longer you have that trade line opened, it's better for you in the long run. It'll help show that stability and the length of the trade line, which will also help with that capacity, which is calculated 30% of that score.
Yeah. And so do we have like an age limit? Can we lend to teenagers, or what is our age that we would ask someone to be before they applied for a credit card?
We currently don't do anything youth lending, so you have to be 18 or older to apply for a loan at the credit union.
Okay. Once you understand your credit score, the next step's kind of maintaining it, building it, maintaining it. So let's move into that and share some stuff with our listeners about that. So we've talked about someone that's brand new to credit, a great way to get them started. What are some habits that you could recommend to an 18, 19-year-old to, really start that first few steps of that?
I feel that when you're a youth borrower or a younger borrower, you need to pick a financial institution that you trust and that you're comfortable with. You need to establish not only credit, but you need to establish a history with a financial institution. Someone that you can trust, someone that you can go to, ask questions. They can lead you in the right direction. It's not always about what type of credit. So if you build a relationship with your financial institution with just a savings, a checking, a direct deposit, we can see those attributes we also take into place when we're looking at, lending money to any of our members. So that's a really good piece that I think people miss. They're always looking at just credit as in trade lines or building a credit score that way. But building a relationship with your financial institution is a big thing, and making sure that as you age and grow that you have that good mix and that never forget about that capacity, because you can be over limit on your credit card. A finance charge could put you over your limit, and that could really drop your score. And it could be, $10 or a late fee or something could put you over that limit, and that's going to really reduce that score. So capacity, a good credit mix, and making sure that you establish a good financial relationship with a trusted financial institution.
Yeah. And so you talked a little bit about some things that people might do that are hindrances, like opening too many credit cards at once. Can you highlight any other mistakes people might make when they're, trying to manage their credit?
I think with my experience, the number one thing I do see, and I'll repeat it several times during this session, is the term that we use. It's called pyramiding debt. And what that term is it is where you're taking out multiple loans. It doesn't have to be just a credit card. It's just taking out multiple loans within an 8 to 12 month period of time and never giving them time to show any repayment. So people think that if they take out a loan and they are like, well, I had to have this loan today, but then they're like, they pay it off in 2 payments. They think that's wonderful and great, but then when the credit, you're trying to build your credit score and your credit history, it's actually hindering them, because it's not giving the credit bureaus enough time to evaluate the information. Like, they've got this loan and then boom, it's paid off. The consumer thinks that that's wonderful, but unfortunately that's something that hinders them. So it's either they're paying things off too soon and then they're retaking something back out, or they're just taking out too many trade lines or inquiries is another big deal that consumers, I think, have misconceptions on, is when you're shopping for credit is what we say. So like, you go to Amazon and you take out a credit card at Amazon, and then you're like, oh, well, I was at Maurice's, so I'm going to take out Maurice's to get my 10%. Or so when all of these inquiries add up, that's also another hindrance for the borrower.
Gotcha. So I'm sure that, in the light of all of these things that we can do with credit, there's got to be some tools and resources out there that can help us manage, monitor. I know there's credit reporting systems. What do we have here at ICCU that benefits our members?
One of our big products that we've just rolled out recently within the last 12 months it's through our online banking process. It's called Savvy Money. It's an amazing tool. We pretty much push this onto our members when they open up accounts now. When you log into online banking, there's an area out there called Savvy Money. It's credit. You can use it to identify what your credit score is. You can see your credit score. It's a soft pull credit score, so it doesn't hinder your score at all. It's not going to hurt you. And there's a lot of credit monitoring tools that are also out there underneath our Savvy Money, where you can go in and actually see, because we do get a lot of members that want to know, can I see my credit report? Can I have a copy of my credit report? Unfortunately, we can't provide that for them. We can tell them what's on there, but we can't give them a physical copy. And through Savvy Money, you're able to see your whole entire credit report. And that's a huge service that the credit union is providing if our members sign up for that.
Nice.
Savvy
And how
Money.
much does that cost our members?
Nothing.
Nothing. That's one of our free benefits
yes.
for them. That's awesome. Yep. And that's available online banking, mobile app. They just go in, sign up for it. It's fairly easy. It's got a lot of great graphics and easy tools. You can set goals and do that kind of stuff. So that tool is probably one of the best ones we have to help out with the credit score.
Yes, and a lot of members inquire about that. They would come in, they want us to go through annualcreditreport.com. That's kind of cumbersome these days. It used to be the tool we would sit down and go over with our members. But if you want to come and see us and want us to help you understand your credit and see things like that, we're going to walk you through our online banking, get you signed up, and get you into Savvy Money so that you can do that on your own at any point in time, and you don't have to come in and have us walk you through if you don't want to. I mean, we're more than happy to help you with the service and explain your credit report to you, but it's right at your fingertips anytime.
That's awesome. And that really does help protect people from fraud, because if you can check that, you're less likely to have some instance that you don't know that's going on your credit report. So let's tackle some common myths about our credit score. I know you've probably had a fair share of these misconceptions in your 25 years, and I know that we've touched on a few of them. What's this popular myth about closing a credit card and hurt your score? I know a friend of mine says she's had hers since she was a teenager at ICCU, and she keeps it open because she knows that that's good for her credit score. So that seems like that would be a myth that helps if you close it.
So the myth is it, the question is, does it hurt your credit score if you close out your credit card? The answer is yes, especially if you're closing out your trade lines that you've had for years. It doesn't hurt you as bad as if you have a credit card that you'd opened 18 months ago and you've paid it off and you're like, I don't want that one anymore and I want to close it. That one you won't see such a huge impact on your credit score. Where it hurts is when you have this, credit card I've had at the credit union for 20 years and now I decided, I don't want that one. I'm going to go over to this one, and you're going to close that. You will see a significant decrease in your score because you're taking away that capacity and the availability to maintain that trade line for all those years. So yes is the answer to that. Yes, you lose that capacity, which again, if we go back, the capacity is 30% of your score. So when you lose that, it's going to bring that number down. It's a big hit.
What about checking your credit score? You've talked about that a little bit. Does that really hurt your score that much?
It all depends on what tool you're using to check that score. So when we talk about credit scores and what hits it or will lower it, when you're trying to review your score, there's a thing called a soft pull credit score, and then there's a hard pull credit score. So when you're talking about soft pulls, which a lot of people use those these days, like our Savvy Money product is a soft pull, there's no impact on your score.
Okay.
But if you're out shopping around, and using it in that manner, it will. I don't know exactly what all the vendors use. I don't know what other vendors use. I know what we use here. So if you're utilizing a vendor and looking at your Credit Karma and these other, I don't know what they use, but if they're using soft pulls, you're safe. If they're using hard pulls, it's every time your credit gets pulled with a hard pull, it's gonna decrease.
Well, that's some great definitions and some terminology for our listeners. So what's the most surprising myth you've come across with your members?
I think the most myth that our members get confused about is when they're talking about their credit cards. A lot of things revolves around credit cards because they're revolving lines of credit. So when members think that they need to keep a balance, an outstanding balance. So when we try to have these conversations with our members about credit cards, like, you want to keep your capacity, use it and pay it off. They're like, well, how come, if I pay it off, it's going to hurt me. No, you don't need to keep a balance on a credit card. You just need to use it.
Right.
So we just recommend put your gas on it once a month and then turn around and pay it off. You can swipe your card for a transaction on your credit card and turn around and pay it off in 2 days, and you're going to be perfectly fine. And I think that's a huge myth that a lot of consumers have on that they think they have to carry a balance or they have to carry it over and pay finance charge, and they don't.
It's just the utilization.
It's the utilization. As long as that trade line's open and active, means that you've used that, you don't have to carry it over month to month.
So if I have no debt, and do I even need a credit score? And what's your advice for that situation?
This is a tough one. When we're working on this, I see this more later in life. With people that have obtained, per se, financial freedom, where they have their house paid off, they don't have a auto loan, all of their, they've hit that stage of their life where they don't carry debt. So unfortunately, if you're not utilizing, your credit, then you're not going to have a score. So when you don't have a score, you're not going to get the best rates because rates are based off what your credit score is. The better your credit score, the lower your interest rate.
Yep.
So unfortunately, when you hit that part of your life where you're at that financial freedom stage, that's where we come back again to that credit card. Like, put something on it every month and pay it off, even though you don't want to and you think it's great not to use credit. That's a way to keep that score up there. So if you ever needed to get an auto loan, that you're going to get benefit of having that best rate because you've maintained that score.
Nice. So we've covered a lot today, from understanding credit scores to some tips and advice for building and maintaining them. Here are a few actionable steps you can take right now to improve your credit health. check your credit report for errors or fraud. And if you are an ICCU member, doing that through Savvy Money is a great place to do so. Pay your bills on time and keep your credit utilization low. So this brings us to the end of our episode of ICCU Solutions for Life podcast, Credit Score 101. Today we explored the essentials of credit scores, what they are and how they're calculated, why they're so important in our financial health. So to recap our key takeaways, know your score. Definitely check that out. Make sure your credit score impacts major financial decisions like renting and buying a car or getting a loan. Understand the basics. Andrea, you did a great job explaining some of the basics. So factors like payment history, credit utilization, and that credit mix play a big role in an individual score. Build good habits, pay on time, monitor your credit, and use your credit wisely. It'll definitely maintain a stronger score. Avoid those pitfalls. We talked a lot about the myths that are out there. Closing accounts doesn't always help, and checking your score won't hurt if you do it in the right way. Remember, improving your credit score doesn't happen overnight. It sounds like it's a long game. It takes a while. But with consistent effort and smart habits, you can build a strong financial foundation. So a big thank you, Andrea, for joining us. Your expertise, it was wonderful and helps a lot of individuals navigate this credit score world, because it's very tough right now in everybody with credit cards and all the things that are out there. So if you found this episode helpful, be sure to follow us on social media or share this podcast with your friends. Visit our website at iccuonline.com for free tools, resources to help you on your credit journey. Thanks for listening. And remember, at ICCU, we're here to be your trusted financial partner every step of the way.